since we know that there's a significant tax benefit to debt within a corporation, there are instances where owners may want to classify what is really a capital contribution as debt, just so that the corporation itself can get those certain tax benefits of having interest expense. And so Section 351 is going to look at, under 351 and a few court decisions, the courts would look at certain factors to determine whether debt is really supposed to be classified as capital. And this is called thin capitalization. If it's too thinly capitalized, then they're going to deem certain debt to be capital. And so, and then they'll eliminate the interest expense based on that. And so let's look some of the instances, and they're listed in your book, but I'm just going to go through them really quickly. It's whether the debt instrument is in proper form. So, for instance, if it's just an open advance where the shareholder's just providing money to the business whenever it needs it, that's different than if the shareholder provides an actual loan with documentation and where there's clear evidence of it, if there's a written promissory note. All of those things affect whether under 385 a debt is considered to be truly a debt and not just a capital contribution. They'll look at whether the debt instrument bears a reasonable rate of interest and has a definite maturity date. If it's just an open loan with no formalities, then that's a concern. They'll look at when the debt is paid and whether it's paid on a timely basis. So if there is paper, which there should be if you want your debt to be treated as debt, like I said, a bank is not going to issue a loan to a business without something in writing saying that the business will pay the bank back. And the same thing should be true for a shareholder. So you really just want to look and see if it actually functions like debt. Also, a bank is not going to allow a business to pay it back whenever. It's going to have actual terms. It's going to have a maturity date. You're going to need to look also at whether the debt's subordinated to other liabilities. And subordination is an interesting concept. If you have the idea of subordination is that the debt would be lower in priority than other liabilities. And shareholder debts often get subordinated because if a corporation, hypothetically speaking, were to dissolve, then the process of dissolution is that this means it goes out of business or it declares bankruptcy. It doesn't always dissolve when it declares bankruptcy, but it's a similar idea. And so the process when that occurs is the company's going to sell all of its assets, it's going to pay all of its creditors, and then whatever's left over is going to go to the shareholders. So shareholders are last in line to take whenever there's a dissolution or a bankruptcy or something like that. And so in this instance, if your debt, quote unquote, debt as a shareholder to the corporation is subordinated to all other debts to the corporation, and that's going to be required usually by the banks. They're usually going to require shareholder debts to be subordinated. But if it is subordinated, then that's a factor that cuts against treating it as debt, because just like the shareholder's shares, he's going to end up taking last. He will take ahead of all other shareholders because his debt will get paid off first. So that's not going to be definitive if that's the case, but that's just another factor that's going to cut against the shareholder there in terms of taking that interest deduction. Then the other issue is whether the holdings of debt and stock are proportionate. So if what we're saying there is, let's suppose you have two 50-50 shareholders that own the stock, and both of them have loaned, quote unquote, the exact same amount of money to the business. It's proportionate. It's proportionate to their ownership interest. If you had 4 equal shareholders and all of them had loaned 25% to the business, proportionate. Now, when you have proportionate loans to the business, that looks an awful lot like they're actually contributions and not loans. And so that's an example where that's going to cut against the shareholder. Now, The inverse of that is true if it goes the other way around. So let's suppose you had 25% shareholders and only 2 of them had given loans. So they'd all put in maybe $10,000 up front in exchange for their stock. And then one of them had put in another $200,000. Well, that's a pretty good indication that $200,000 is really a loan, because if he only received the same amount of stock as everybody else, even though he put in a lot more money, then that money must have been put in there for a reason, and that would cut towards it being treated as a loan. Whether funds loaned to the corporation are used to finance initial operations or are capital asset acquisitions. So funds used to finance initial operations or acquire assets the corporation needs in the business are generally obtained through equity investments. So that's another one that's going to cut against it being debt. So there you go. And then one other one is whether the corporation has a high ratio of shareholder debt to shareholder equity. And so thin capitalization occurs when shareholder debt is high relative to shareholder equity. This indicates that the corporation lacks reserves to pay interest and principal on the debt when the corporate income is insufficient to meet current needs. So if you're thinly capitalized, and in determining the corporation's debt to equity ratio, courts are going to look at the debt both to the book value of the corporation's assets and to their actual fair market value. So this is the concept of just being thinly capitalized. You don't have enough money in your corporation to pay the obligations unless you're going to just keep making a lot of money or accept out of the income of the corporation. So if you're running a really, really tight ship in terms of capitalization, if you just don't have enough money, why they care about this is essentially they're going to look at it and say, if you don't have enough money to pay your debts, then the shareholder's just going to allow that payment to not be made. And that when the payments of interest are not contractually obligated, they don't have to be made constantly, then that looks a lot more like a shareholder holding stock and just waiting for a dividend when the money can come out, when the money is there to come out. So once again, its debt looks a lot more like interest. And so interest deductions will be disallowed under 385. Under 385, the IRS also has the authority to classify an instrument either as wholly debt or equity or as part debt and part equity. So this flexible approach is important because some instruments cannot readily be classified either wholly as stock or wholly as debt. So there you go. So there's a possibility that they will partially consider a debt to be equity. And that's Section 3 of IRC Section 385. All right, so we've kind of spent some time on capital contributions in general, shareholder contributions, for instance. A lot of focus on 351 there, but other types of shareholder contributions that are not under 351. That's really the concept that we spent some time on, understanding that if a transfer to a corporation is made by a person or a group of persons who end up controlling the corporation after, 351 applies. If not, then it doesn't. So if 351 applies, the no income gain loss is recognized by the corporation from exchanges of the corporation's stock for contributions, or even for contributions without the corporation issuing stock. And that's as long as it's on a pro rata basis. And the idea there is that if you make a stock distribution or exchange property for stock where all of the current shareholders are contributing, all you're doing is adding the number of shares. You aren't actually changing the ownership, and cutting the same piece of pie into multiple parts isn't actually generating any economic consequence. So that's the shareholder contribution segment focused on 351. Now we're going to talk about something a little bit peculiar, and that's non-shareholder contributions. And this is interesting because why would a non-shareholder contribute to a corporation? And you would think that, generally speaking, if any money is paid into a corporation, it would be by somebody who
is getting something out, it's some kind of compensation, it's some kind of exchange for something. But there are instances where corporations are simply given basically gifts, although they oftentimes have strings attached. A good example of this would be like a city that wants to keep an NBA team in the city. Oftentimes they will give them land to build an arena, or they will give them other incentives to stick around. Now there's somewhat of a quid pro quo there. They're giving them this arena so they know that they're going to stay. But at the end of the day, the corporation isn't really being paid for doing something. There may be some strings attached, but again, it's really just a gift to the corporation because they want to get something out of the corporation, but not in exchange for that gift. It's just consequent or as a result of the gift. Another example would be a company receiving a piece of land from a small town where the town's giving them the land so they can build a factory. Really no strings attached except that the city knows that by giving this land they'll be fulfilling a need for the company, and then they'll be generating jobs in their city. So that's kind of two examples of where non-shareholder contributions could come in. Other instances might be where essentially a gift is made to somebody, but made directly to the corporation owned by that person, but that gets a little bit messier. So once again, kind of a rare concept, but interesting nonetheless, because it helps us think through how basis functions internally for the company. So contributions of property by non-shareholders do not result in income or gain, but the corporation takes the property with a zero basis. So that makes sense. If the property were given to the company and the company didn't have to recognize any income from that property, if they took basis at the level of fair market value, then the result of that would be if they sell the property, they don't have to recognize any gain. And if the property goes down in value, they could even recognize a loss and use those losses against other income. So you can see how it makes sense that they would have a zero basis since they didn't recognize any income, they didn't pay anything for it. Pretty straightforward. Contributions of money are a little more complicated. So with contributions of money, the non-shareholders reduce the property purchased, the basis in that property, for any property purchased in the next 12 months following the contribution. And then the excess, if any, reduces the basis of other property held by the corporation. So the idea here is cash always has a basis, right? So if you can't have zero basis cash like you do for contributed property. So we have to find another way of avoiding this circumstance where the company gets this huge benefit of having property with basis in it by virtue of the gift without recognizing or any income. So the way we do that is we essentially have this negative basis that's just floating around, and we apply it to property that's purchased in the first 12 months. Whatever property they purchase in the first 12 months, we're going to zero out that basis or bring it down to the extent of the money that's been contributed. One of the interesting things about that is you might not have enough property that's been purchased, and so you have this leftover negative basis at the end of 12 months. And that's where it reduces basis for other property that's held within the corporation. And it does so in the following order. First, depreciable property. Second, property subject to amortization. Third, property subject to depletion. And lastly, all other remaining properties. You can see this is kind of interesting. Essentially, that negative basis is going to attach to the property that would be the most tax beneficial to the company. So property that's depreciable, for instance, you get that depreciation deduction every year and you count that against current income. So what this does is automatically removes that depreciable property, lowers its basis without a corresponding deduction. And so very similar to taking a zero basis in property up front. You're eliminating valuable deductions, but at the same time, you got this money for free.